Hi again, everyone. This is Ed the Finance Guy. Appreciate you tuning in again. Keep listening. I love doing these videos. I like teaching people. Education is number one. Like, subscribe, share. It is much appreciated. If you have any questions, concerns, please, ed1959@usa.com. Today's topic is going to be on W-2 wages, 1099 wages, and home office deductions. So there are two ways of getting paid. You can either get paid as a W-2 worker, where they take your taxes out, they take your Social Security, your federal, your state, your local, maybe they take out for health insurance. That's one way of getting paid. Second way of getting paid is a 1099, which is a self-employed subcontracting way of getting paid. So if somebody works for you and they only work one day a week, they come in, they do some work for you, you give them a 1099, you don't take any taxes out of their check, they pay their own taxes, they're responsible for their own taxes, and that's the correct way to pay a 1099 person. And when you have any kind of a workers' comp audit and they want to know who got paid, they always want to know who the subcontractors were, because in case somebody gets hurt while they're working for you, you want to make sure they're covered. So when you work at a job, you have your W-2, you have taxes taken out, you're working 9 to 5, 5 days a week, it's a full-time job, they have to pay you W-2. When you're working part-time for somebody, here and there, somebody will come in, do tax returns for me for 10 hours, I'll pay them, I'll give them a 1099, because they're technically not working for me, they work for themselves, they could work at other companies, they could work at other jobs, they could do other things. So those are the two ways of getting paid. If you're an employer, you try to pay people as 1099s only. And the reason that they do that is because they try to avoid paying their share of Social Security. Because if I have a worker that works for me and he makes $100 a week, I'm taking $7.65 out of his check from his Social Security portion, and I am paying $7.65 out of my pocket to have that guy working for me. And beside that, I'm paying his workers' comp, I'm paying state unemployment insurance. So a lot of employers try to scam the system a little bit by paying people that work for them, even if they're full-time, they want to pay them as a 1099 person. The Labor Department has a bunch of questions about that. They want to know exactly why you determined this guy to be a 1099 person. And the questions are going to be, does he work for you 9 to 5? Can he have other jobs? Can he wear whatever he wants? Does he have to wear a suit? Does he have a desk in your office? Does he have a secretary? Now, if you answer all these questions, yeah, he has to do all these things, then he's not a 1099 person. He's a W-2 person. And the Labor Department is going to say, hey, wait a minute. You made these people 1099 people because you wanted to save money. You committed a fraud and we're going to fine you. And that happened. I worked for a brokerage firm for many years ago. I won't mention the name. And we were all paid as 1099 contractors, even though we had desks, we had secretaries, we got calls, bond calls with people calling in for information, and we had to be at the certain job, we had to wear a suit and tie every day. So how could we be 1099 subcontractor, self-employed people if we have all these rules? So that company was fined over $1 million from the Department of Labor. So if you're gonna go work for somebody and they wanna pay you a 1099, it's better that you get paid as a W-2. If you get paid as a 1099, you have to put that on a tax return called a Schedule C, and you have to pay double Social Security on whatever money you make. Now, you're gonna get 1099 from like 4 or 5 different people maybe, or 2 different people. You're putting it on the Schedule C, you're totaling it up, and your deductions will be whatever, accounting services, office supplies. And then at the end, the bottom line number after expenses, you have to multiply that by 15.3, which is twice the 7.65% Social Security. So you want to make sure that you're not 1099 at your job, that you get a W-2. The only reason you're getting a 1099 is because it's better for the boss. It's not better for you. He's saving money, it's costing you money. Try to work at a job where you're W-2'd and taxes are taken out. At the end of the year, you're not going to owe a lot of money. Maybe you'll get a refund. If you're going to get 1099 by different companies and you really truly work for yourself, you have choices in how you want to set up your business. You could have a corporation. The corporation, you contact Albany, an attorney, an accountant, and they set up a corporation for you. And the corporation could be, you pick 3 names, and whatever name is available is the name you're gonna get. And that corporation gives you protection. If you get sued, they can't come in and take your house, take your car, can't take any of your personal property because you have a corporation. That corporation protects your personal assets. So the three different ways would be a corporation to open, or an LLC, which is a limited liability company. Now, the LLC has the same protection as a corporation, but you have an option of filing returns either as a single member LLC, which would be on a Schedule C, or you could file an LLC as a corporation, or you can file an LLC with another person as a partnership. So that's something individual. You should really go speak to your accountant, your lawyer, to see which is the best way for you. But you want to get protection on your personal assets. You have a business. You don't want to sacrifice your home in case you get sued. You don't want to lose your car. You don't want to lose any of your personal assets. So being incorporated really is the best way. Whether it be a regular corporation, an S corporation, an LLC, all topics we're going to cover in further videos down the road. But again, if you wanted to stay independent and you don't want to incorporate, you don't want to pay the fee to incorporate, you put it on a Schedule C. The Schedule C is going to be listing all your 1099s, having all your expenses, as I mentioned before, rent, telephone, anything to do to build your business, advertising, promotional expenses. Maybe you took out somebody for dinner and you're going to eventually get business from them. Just make sure you log that dinner in your journal to show the IRS if you get audited. I met with Mr. So-and-so about a job I'm trying to get. We went to a restaurant. Here's the receipt. You have the receipt in the book. You got to make sure that everything you do is documented. You have to make believe you're the auditor and you're the one auditing the person. And what am I going to look for to see if this guy's telling the truth? I want to see the receipt. I want to see his daily logbook, his journal. I want to make sure he wrote off a dinner with a client and not necessarily a dinner with his family. Get the client to sign the receipt. That's always good proof as well. Now, the most important thing on the Schedule C, people always seem to ask, and the IRS really has a lot of questions, seems to be a big audit problem, an audit point with the IRS, is a home deduction. So I want to write off part of my house. I work out of my house. Right now, a lot of people are working out of their house. How do you write it off legally and not get in trouble? Now, if you have a laptop sitting on a living room table, that doesn't count. It's got to be a totally separate space that you consider an office, that you use as an office, that you go to all the time, not a place your kids play in, not a place anybody else goes in. It's a place specific to you and your business. Now, if you have expenses for that room, like a desk, a chair, computer, office supplies, things like that, you can write the whole thing off. So if you wanted to write off, let's say, for example, your mortgage payment, you have to look at your office space. Let's assume your office space is 200 square feet and your house is 2,000 square feet. That's 10%. They go by a pro rata share of whatever the office space is square footage wise to your house. So 200 square feet is the office, 2,000 is the house, 10%. You could write off 10% of all your expenses, including landscaping, utilities, phone bill, anything to do with the house insurance. Now, when it comes to the mortgage, you have to be very careful. You can't write off 10% of the mortgage, because remember, if your mortgage payment is $2,000 and $800 of it is real estate tax, you're already writing off that $800 real estate tax number on a separate schedule on the return. And your mortgage interest of $700, you're writing off also on the same schedule. So of that $2,000 mortgage payment, you already are writing off $1,500 on other schedules. So if you take 10% of the full $2,000, you're taking off the deduction twice. You're taking it off mortgage interest, real estate tax, and you're taking it off a percentage of the house. So you can't do that. So what you do is you take your mortgage payment, subtract out your real estate taxes, subtract out your mortgage interest. Let's say it comes out to $500. You could take 10% of that $500 towards rent. So very often you just have a schedule, you write down all the expenses for the house, take a percentage, and every month you write yourself a check, use that check, put it in your personal account. The other thing is make sure you have separate checking accounts, one for your business, one for your personal. Do not commingle the money. You'll have a very hard time a year or two from now to explain what this check is for, what that check is for. You have a separate account, even if it has your name or your company name, make sure it's separate from your personal expenses. So if you're going to take income from your business, put it in your regular account and write your personal expenses. Do not write your personal expenses out of your business account. It's going to be very difficult proving what expenses are personal, what expenses are business. If you have a personal credit card, try to get a business credit card. Try to make sure you have a differentiation between the two. So when you get audited, you have to assume you're getting audited, even though you probably won't get audited. You'll be able to show them, this is my expense for my business, this is for my house, this is the credit card, I have a separate credit card for my business, your personal expenses, your personal income, your business expenses, your business income. You wanna make sure you can prove yourself in an audit. Try to have everything segregated. Sometimes people wanna know if they should take depreciation on the room that they're in the house. Now, depreciation is if you own a building or a piece of furniture, you could write off a percentage of it every year. And rental property could be 27 and a half years, and business equipment could be 5 years, depends on the item. And what it is they let you write off a percentage. So let's say a building that you're a rental property, you could write off 1/27th of the amount you paid for the building less the land expense. And you could write that off every year as a depreciation expense on your return. The thing is, you have $1 million building and you write off $27,000 in depreciation for 10 years. You go to sell the building, you're selling it for $1.5 million. What did you pay for it? $1 million? No, you have to recapture the depreciation. So it's as if you paid $1 million minus the depreciation you took in the previous years. So now you're down to $750. Now all of a sudden you're paying taxes on a larger amount of money because you took the depreciation. The depreciation helps during the years you're taking it, but when you sell the property, it doesn't. And when you're taking and selling a house, there's different regulations about individual houses, rental property. It's going to be very confusing if you take depreciation, which won't amount to a lot of money anyway. I'm telling my clients not to take the depreciation on the property because you don't want to have to recapture it. It's going to be a little bit confusing to do that. So again, if you're going to take a home office deduction, make sure you have everything legitimized, figure out your expenses monthly, your true expenses. Anything to do with maintaining the house, you could write off a percentage. It's based on the square footage of the office to the house. It can't just be an empty room that you're throwing a computer down on and making phone calls from. It has to be a legitimate office. It can't be the side of your bedroom, next to your bed, there's a table. No, it's gotta be a completely separate, segregated office. It could be a garage that you're using just as an office. That would work too. So I wanna thank everyone for listening again. I hope this was very informative and educational, because that's my goal. Knowledge is power. I want everyone to learn as much as they could possibly learn. Tune in next time. We're gonna start my series on credit repair, how to fix your credit, increase your FICO scores. What does it mean to have bad credit? We're gonna go over a lot of topics. Keep tuning in. It's Ed the Finance Guy saying, stay safe, be smart, subscribe. Tune in next time.